All right. Well, welcome everyone. Welcome to Crux's webinar discussing the benefits of domestic manufacturing incentives and tax credits that were enacted as part of the Inflation Reduction Act. My name is Katie Bays. I'm our policy and research strategist here at Crux. We'll give a quick introduction to the panel and take a few minutes to kind of lay out what we'll be discussing today and allow folks to join the Zoom webinar. Very quickly, a few housekeeping items. So first of all, again, welcome to Crux's Advanced Manufacturing and Domestic Manufacturing Tax Incentives webinar. We'll talk through a lot of material today. There are a couple of reminders here quickly. So first and foremost, this event is off the record and it is closed to members of the media. So if we do have a member of the press who has inadvertently joined the webinar, we would just kindly remind you that this webinar, like all of the others we host, is closed to media. I wanted to just say at the top that we are recording this webinar. It will be distributed. The recording will be distributed to everyone who has attended or registered after the webinar is complete, and it will also be available on Crux's website and our YouTube channel after the event concludes. Lastly, if you have questions throughout the webinar, we really welcome your input. We have a Q&A function here that folks are welcome to submit questions to. At any point throughout the webinar, please feel free to do that. We will take as many questions as we can. And so without further ado, let's get into it. So we are here today to discuss a wide range of topics related to the incentives that support domestic energy manufacturing and supply chains. We're going to run through an overview of the direct incentives, the 45X and 48C advanced manufacturing and advanced energy project tax credits. And then we will also pivot to discuss the domestic content bonus, which is claimed by energy project developers on projects that meet the requisite domestic content thresholds. And then finally, inevitably, we are going to reserve a few minutes with our panel to talk about the political lay of the land. I am delighted today to introduce our expert panel. We are joined today by Ethan Goldman, a partner with Davis Polk, where he advises clients on federal income tax matters. Ethan also regularly advises private equity sponsors and other private fund managers on tax matters related to the formation and operation of private investment funds. We're also joined today by Justin Bowman with KPMG's Trade and Customs team. He's part of the firm's international tax services, and his team helps companies build and maintain a best-in-class trade compliance program by balancing compliance and business needs. And finally, we are joined by Yogan Kathari, who is from the Solar Energy Manufacturers of America Coalition. SEMA advocates for policies that support a competitive, environmentally friendly, and socially responsible US-based solar supply chain. Yogan has over a decade of experience serving in both Congress and the nonprofit sector and has a keen understanding of how to shape, influence, and advance public policy through federal advocacy. So I'm sure everyone who is on the line with us today can understand why we are so excited to hear from this panel. And so to kick it off, I thought we could start with a discussion of kind of one of the most talked about and most impactful parts of the IRA, the 45X advanced manufacturing tax credits. I'm going to hand it off to Ethan to give us a quick overview of how his firm, how Davis Polk is interacting with and seeing the evolution of the 45X tax program. So Ethan, I'll hand it off to you.
Sure. Thanks, Katie. So, yeah, as Katie mentioned, I'm Ethan Goldman. I'm a partner in the tax group at Davis Polk. And, I thought maybe we could start just by going over the basics of Section 45X, which was added to the Internal Revenue Code as part of the Inflation Reduction Act in 2022. So this is the 45X credits it's what's called the Advanced Manufacturing Production Credit, and it is a production tax credit that is able to be claimed by taxpayers who produce and sell eligible components, and I'll get into what that means. But it's a production tax credit that is kind of claimed on a per component per sale basis. The components that are eligible for 45X are sort of products that are produced in clean energy industries. And so specifically, there's a tax credit for certain solar energy components. There's a tax credit for wind energy components. There's a tax credit for qualifying battery components. And then there is also credits for the production and sale of critical minerals and certain types of inverters. And if you look at the 45X rules, the amount of the credit kind of varies based on what the qualifying component is. And so, there's sort of kind of go through the statute and it says, okay, well, if you have this kind of a component, you get this amount of credit per component. But the kind of basic requirement is that you need to produce and sell the component in the tax year in which you're claiming the credit. And so kind of unpack what that means. To produce the component, the taxpayer needs to essentially manufacture the component in the US. Or if you're, in the world of critical minerals, it would be kind of extracting or processing or processing in the US. Now, manufacturing can be complicated, especially where you have sort of businesses with contract manufacturing arrangements and that sort of thing. There are special rules in the 45X regulations that deal with contract manufacturing. The default rule being that it's the kind of the party that is actually sort of physically transforming the product would be the one to claim it. But then there's a special rule that basically says parties to a contract manufacturing agreement can agree by contract that one party will claim the credit if the other party agrees not to. And so there is kind of a fair amount of flexibility. And I think the takeaway there is really that if you are kind of in a contract manufacturing arrangement, it's important to specify which party is going to claim the credit in the agreement. Production also if you look at the 45X rules, it excludes quote unquote minor assembly and partial transformation. And so, for example, if you're kind of taking two fully manufactured pieces and attaching them together with screws, that's not qualifying production, and there needs to be sort of a substantial transformation of the raw materials into a product in order to qualify for 45X. But, broadly speaking, it's a manufacturing credit and, applies, for the components that are produced by the taxpayer in that year in the US. The second component of 45X is that it needs to be sold. So the tax credit applies in the year of the sale, not the year in which the property is produced. And so, and the sale, with one exception, needs to be sold to an unrelated person. And so if you think of kind of like a very basic example, if you have, a manufacturing facility that produces, battery cells, and then those are sold to an unrelated person, in 2025, the credit would be computed based on the number of cells that are sold, and the credit would be taken in the year. The world can be more complicated than that because you can have kind of related parties where one is doing the manufacturing and then a different party is maybe incorporating a product into a larger product and then selling it. And so there is a special rule that says that for related party transfers, the taxpayer can elect to treat a sale to a related party as a sale to an unrelated party. And then you basically take the credit on that transfer and you wouldn't take it on the kind of the subsequent sale to the unrelated party. So again, there is sort of a fair amount of flexibility in the rules in terms of when the credit is taken, in terms of which party in the manufacturing arrangement takes it. But I think the basic idea is that there's rules to avoid duplication of credits, and also that ultimately the products need to be sold to third parties in order for the credit to be claimed. Now 45X, it's time limited. So under current law, the credit begins to phase out in 2030, and then it completely phases out after 2032. So beginning in 2033, absent sort of any changes in law, 45X would be completely phased out. But until 2030, the full amount of the credit applies, and then there's sort of step downs that apply between 2030 and 2032. So that's kind of 45X. That's a production credit. I think that's what we're going to spend most of the time talking about. I did want to touch very briefly on section 48C, which is the investment credit for qualifying advanced energy projects, because it is sort of a companion to 45X in that it is a investment credit that applies to sort of manufacturing and investments in facilities that are associated with clean energy. Is often kind of talked about in conjunction with 45X. This is an investment tax credit that needs to be awarded by the U.S. Treasury, and so basically there was an authorization of up to $10 billion of credits that were awarded to taxpayers that have applied to the Treasury after the enactment of the law to have their facilities sort of qualified, and then the credit would be awarded on that basis. What types of facilities qualify? Well, it's manufacturing and recycling projects that are either sort of retrofitting or re-equipping old technology for sort of new clean energy technologies, or related to greenhouse gas emissions, or facilities for processing, refining, or recycling critical minerals. All of these credits have now been awarded, the last of which was in kind of early January of this year. Just to kind of say that it's out there, but I think we're probably going to spend most of the time talking about 45X because it is sort of an ongoing credit that can be claimed. That's 45X. I think we're going to talk a lot about transferability and monetization. Maybe I'll just kind of give the basics right now. There's two ways under the Inflation Reduction Act that 45X credits can be monetized by the taxpayer. One is that under the direct pay rules, there's a special rule that allows taxpayers that are taxable, companies or taxable taxpayers, so not tax exempts, to be able to claim the 45X credit as a refundable credit from the government. And so that's what people often refer to as direct pay. The Inflation Reduction Act kind of introduced the concept of direct pay. It hadn't been in the code before. But essentially, for most credits, the direct pay rules apply to state governments and tax exempts and other entities that otherwise aren't paying tax and therefore don't have income against which or tax liability against which a credit can be used. And so the direct pay rules are, basically to incentivize those types of entities to invest in clean energy, and they have the ability to claim a direct payment from the government equal to the amount of the credit. The 45X credit is one of 3 credits that taxable entities can elect into direct pay. And so there's a special election that can be made where if a manufacturer wants to claim direct payment from the government for 45X credits, they can make the election, and then for the year in which the election is made in the next 4 years, so it's a 5-year election, the credit will be essentially reported to the IRS and is refunded refunded to the taxpayer as a payment from the government. So that is kind of one option to monetize the credit. And remember, the credit lasts until 2032. And so if the direct payment election is made, it's only good for 5 years, and then after that, there would the taxpayer either needs to claim it as an offset to tax liability or transfer pursuant to the transferability rules. So transferability, which I think is mostly what we're going to talk about in this webinar, is the other way in which taxpayers can monetize the 45X credits. There's a whole set of regime that was enacted as part of the Inflation Reduction Act that allows taxpayers who are generating tax credits to transfer those credits to third-party unrelated taxpayers under Section 6418 of the code. And 45X credits are one of the sets of eligible credits that can be transferred. The 48C credit can also be transferred under these rules. And just in kind of my practice, I'm seeing a lot of transacting in all types of kind of clean energy tax credits, but 45X, we're definitely seeing a lot of transacting in that space between sort of manufacturers of qualifying components and third-party buyers that are looking to purchase credits to offset their tax liability. So maybe I'll stop there, Katie, and if you want to kind of move on to the next question, and then we can come back to any of these points that I went over at a pretty high level.
Yeah, that was wonderful. Thank you. It's very thorough. And of course, there's a lot of complexity here, but I think one of your points, Ethan, is that there's also a lot of flexibility in terms of how people claim these credits and then also monetize them. And I think that's perhaps one of the core reasons why it's already been such a successful provision of the tax code. But on that subject, Yogan, I wanted to come to you, and obviously, this is the bread and butter of what you all do at SEMA, is working in and around the 45X program. So wanted to see if you could reflect a little bit on how your members have benefited from access to these credits, and just even anecdotes related to how these tax credits might be supporting the expansion of domestic manufacturing supply chains.
Yeah, I mean, look, the SEMA coalition came to being around what what effectively was the predecessor of what became 45X, which was Senator Ossoff bill and Representative Kilde's bill, the Solar Energy Manufacturing for America Act, right? And so this was a unique way, I think our members came together and saw that, we have polysilicon with Hemlock and Wacker, we have module manufacturing in the US with Q cells and First Solar. But we were really missing kind of this middle core piece of the supply chain on the solar side with solar wafers and solar cells. And what was it going to take to kind of bridge that gap and really decouple and de-risk the supply chain from China and Chinese controlled supply chains? And 45X is kind of where that is what ultimately resulted in what became 45X. And it was this kind of unique way to incentivize manufacturing. But I think, from our coalition's perspective, it was not just the what's really important, and Ethan said this, it's produced and sold, right? You have to sell the product that you're making here in the US to get the credit. And so having that supply incentive, but also the demand driver in 48 Cap B is critical, and having, project developers want to buy domestic was critical for the success, and will be critical for the success of 45X. So as part of 48 Cap B, the tech neutral investment tax credit, you had the domestic content bonus, which added that kind of 10% adder if you had a certain amount of domestic content. And I think with the most recent domestic content guidance that came out earlier this year, I think you saw that value through most of the solar supply chain, which was very beneficial. And I think it's that really drives a lot of that investment in the US. Obviously, for manufacturers, they still have to be able to monetize the credits, and tax equity doesn't work the same way for manufacturing as it does for maybe project development. And so for especially a lot of next generation technology manufacturers like our perovskite manufacturers and the like, having transferability throughout the duration of 45X is so critical, because it will help them with financing, with hiring decisions, with cash flow. They're making risky investments to compete with China's market manipulation. And so having that liability, they're not going to have that much liability on the books when they're making these investments. And so pairing 45X in a way with transferability was very essential for the success of the onshoring of across the supply chain. And a lot of our members leverage transferability to make those large billion-dollar investments throughout the country.
Thank you. Yeah, that's really helpful. And I wanted to add just a bit of data from the Crux perspective, kind of underwriting what you just said, Yogan, which is that, our data has really found that 45X is the largest part of the transferability market. It's the single largest tax credit category and technology type that we're seeing in the market. It was 33% of all the transfer deals that were done in 2024 in our data. And the pricing on these deals is also very competitive. We aren't seeing a transfer market that is really preferential towards the traditional technologies and sort of discounts these newly eligible projects. It's a very, equal opportunity market. And 45X has been one of the most in demand and I think successful categories that we've observed. So I think it's very important to know how much the industry is really taking advantage of this program, but also how it contributes to, as you said, the financing needs that companies have as they try to expand production. But Justin, I wanted to turn to you now and just get your perspective at KPMG in terms of are there pitfalls that you have seen companies experience in trying to claim 45X, or do you observe, I'm especially curious in light of some of the tariff discussions, whether or not those have been factors in how you've interacted with some of the manufacturers.
Yeah, thank you, Katie. So KPMG, for 45X, we support clients in many ways. So depending on who you ask here, they'll give you a different perspective. But I'm in the trading customs group here at KPMG. And so our primary focus is to help clients understand tariff impacts, as well as what is the country of origin of the items that they're importing into the United States. And that's where our overlap as our trading customs team overlaps with 45X, because as we know, as Ethan explained, one of the requirements of 45X is that a product is produced in the United States, and that the term "produced" means the eligible component is made is substantially transformed, and the materials or components to make that eligible component go through a complex assembly process, and something that's more than minor assembly. So that's one of the, I wouldn't say footfall, but larger learning curves under 45X is navigating the meaning of the term substantial transformation. So for any manufacturers or contractors or developers on the call, I will tell you that under 45X with your tax or accounting or legal team, substantial transformation might be a new term, but it is a widely used term that has been around in the trade world for many years. It's a term that we use every day when helping clients understand tariffs. So if you are looking to navigate whether a process is substantially transformed or a component has been substantially transformed to be considered produced in the United States, I highly would recommend to loop in a trade compliance professional, because it's a term that we use on a daily basis. So that's how we're working with many manufacturers, because we are seeing that tax insurers or other investors, even if the credits are transferred, they want to see that level of due diligence review that the component was substantially transformed in the United States. So we're helping, manufacturers document that process, help identify, any areas of the process that could be deemed simple assembly, just so that at the end of the process, they can clearly say and claim that the eligible component was substantially transformed in the United States. And then tariffs definitely play very parallel to this. As the regulations state, the subcomponents themselves should be substantially transformed. That does leave an opportunity for certain subcomponents to potentially be imported. So we are, helping manufacturers or clients understand scenario planning. If they import tariffs, or if they import a certain subcomponent, what would that tariff be, versus trying to source that certain subcomponent domestically. So it's definitely a good balance of the two knowledge areas, to help manufacturers just stay educated, and be aware of what substantial transfer means, and help them navigate that. Because again, it is a relatively new term for tax professionals, but from a trade compliance professional like myself, it's a term we use every day. So that's really how we're helping manufacturers navigate this.
Well, thank you. Well, I thought I would kind of open it up a little bit more broadly, but Ethan, I wanted to go back to you with a specific question about just, we all know that in order to expand, and I think Yogan, you obviously talked about this, in order to expand domestic manufacturing, companies have to invest. And there are, of course, a lot of factors that support investment, but the tax credits are an important part of that. And so, one of the things we're really interested in learning more about is how, or have you seen manufacturers really successfully pull forward the value of their tax credits for the purpose of securing financing or a new investment? And then also, what challenges have you seen?
Sure. Yeah, no, I'm happy to talk about that. I mean, I think that, in terms of in 45X, because it is a production credit, there's a timing component to sort of when the credits are sold and when buyers are willing to pay for the credits. But it is a way of obtaining sort of either financing or at least sort of a reliable kind of sort, if it's a kind of contract where the buyer is paying over time for some period of time, it's a reliable source of cash that's coming in that can be used by the manufacturer and to basically ensure that they have financing for other uses. In terms of like when I think about kind of what are the issues that come up in your typical 45X transfer transaction, I kind of put it into three categories. I think one is sort of timing of payment, and with that kind of what are the conditions that need to be satisfied for the buyer to pay for the credit. Second is sort of diligence, which isn't really in the contract itself, but sort of what does a buyer need to do to satisfy itself that it's buying credits that are qualifying. And then the third is kind of dealing with risk, that the credits are either challenged or lost, and that kind of comes in two main ways. One is sort of seeking indemnities from the tax credit seller, and then the other would be getting third-party insurance to insure the risk. Just kind of as a very high level, the way that the transfer rules work is that the buyer generally steps into the shoes of the seller for purposes of any kind of subsequent disallowance or other risks associated with the credit. Because 45X is a production tax credit, I think the real risk is that the products on which the credit was claimed, either weren't qualifying, or the amounts were miscalculated, such that there was a higher amount claimed on the return than was actually available. It's a little bit different than when we get into the investment tax credit transfers, and so for Section 48 and 48 Cap E projects where the tax credit seller is making an investment in a new project and then claiming the investment tax credit in the year that it's placed in service. There, buyers kind of step into risk of recapture because the credit kind of vests over 5 years, and if the project is taken out of service or sold within the 5-year period, the credit gets recaptured, and then so there's kind of other risks associated with the investment tax credits that aren't really present in 45X, and that may account for, Katie, what you were talking about, how it's such a large piece of the transferability market, just given that I think people generally view 45X credits as having a lower risk profile than some of the other ITC deals. But there's still risk that needs to be negotiated and allocated under the transfer agreement. And I think that, usually what I've seen is that buyers will agree to sort of pay for credits either on a periodic basis, whether it's quarterly or semi-annually or annually. And there's a process by which the seller has to certify to the buyer that we produced X number of components, and here's materials that provide evidence that the products were produced and sold. Here is the sort of computation of how we get from the sales data to the amount of the credit that's being claimed. And there may be sort of a diligence process that a buyer goes through to get comfortable that the facility is a qualifying facility that's able to produce qualifying products, and the products are themselves qualifying. That kind of varies deal to deal. I think you'll probably see much more robust diligence processes in some of the really large transactions, and on smaller transactions you might see less of an investment in that. But that is something that we've seen in our practice. On indemnities, I think it's fairly standard for sellers to provide a pretty comprehensive indemnity to the buyer in the event that the credit is challenged. And the question really comes down to, so who is the seller and who is the party providing the indemnity? If it's a special purpose entity that owns nothing but is basically taking an inventory and selling, not going to be very creditworthy for an indemnity, whereas usually you look to have kind of a parent guarantee or an indemnity coming from an entity that's sort of higher up in the structure that will have more creditworthiness to stand behind an indemnity. We'll also see transactions where there will be an insurance policy taken out against some or all of the potential risk associated with disallowance. And so sometimes there's a mix of insurance and indemnities. I think one place where we're really seeing a lot of kind of back and forth, and I'm not sure the market is really settled, is just around change in law, particularly in the current political environment. We definitely, I think it's becoming more normal for there to be sort of negotiations around terminating the agreement in the event of a change in law or renegotiating price. I think that what is less sort of settled is how do you deal with proposed changes in law, or governmental actions that don't really amount to a legislative change, but maybe sort of an executive action or something like that. All of that is very much sort of being negotiated in live deals, and I think coming out different ways depending on the relative bargaining power of the parties.
Yeah, there's obviously a lot going on. And we did get a nice question that I want to use before we pivot to talking about domestic content. And just as a reminder to everyone on the call, you're welcome to submit questions through the Q&A box. Got some really good ones that have come in already. So before we pivot, there's a question about kind of the process for obtaining 45X and establishing that a product qualifies. And then under some of the kind of subdivisions of, so you have an inverter, is it a central inverter, utility scale inverter? And Yoga, I wanted to actually direct that to, of course, it's a legal question, so Ethan, you will certainly, I think, have something to say, but I also wanted to hear, Yoga, from your point of view, this is basically it's a 2-year-old credit category. How settled do you think the industry has become in terms of navigating some of these questions? Or do you still experience with your members that, there is a unique fact pattern in all situations? Everyone's taking, an approach that maybe has some differences, or do you feel like it's becoming more standardized in terms of what it takes to qualify for 45X?
Yeah, I mean, speaking on behalf of my members, I mean, our members, are producing polysilicon, are producing wafer cells, modules, the next gen tandem modules. And so I think the regulations from the 45X regulations that were finalized last year are pretty explicit and clear, at least from our perspective, in terms of, what qualifies and what doesn't, what, to Justin's point, what substantial transformation is. So, you're connecting the junctions and all that stuff to make sure that, the cell qualifies, for example, what it means to actually make a wafer here. I think the definitions in the law, along with the regulations that were finalized last year, make that pretty clear, at least on the solar side. So I'll say on the 45X perspective, I think for our 20 or so members, it's been relatively straightforward. There are some questions here and there on like tandem cells, next generation cells, because I think the way the IRS approached that still left more, created more questions than answers, but we are a couple years away from that technology really coming to bear. And so I think we have some time to kind of get some answers once we have some certainty in the law and the credits sticking around or not. But yeah, I would say, at least from our perspective, it's been relatively straightforward. And my members have found the pre-registration process and all that, I'm sure Ethan and others can talk more about, relatively easy to navigate to claim the credit.
Yeah, maybe Ethan, to you, maybe to cover that pre-registration process. And if you wanted, maybe you mentioned the 2 monetization pathways, transferability and direct pay, and might be interesting to share, any differences between how a taxpayer navigates claiming one or the other.
Sure. I mean, just the pre-registration, what that's referring to is there's a process by which if you are manufacturing qualifying property under 45X, the facility needs to be registered under an IRS portal that basically you go in there and you enter in the information related to where the facility is, what it's manufacturing, that kind of thing. That information gets submitted to the IRS, and then you get a sort of a pre-registration number that is verifies that the IRS has accepted it. At that point, now you can you need that in order to transfer the credits. And so the way in which the credit transfer is claimed is basically the seller and the buyer enter into what's called, there'll be an agreement to sell those credits, but there will be a form called a transfer election statement, which has information like the amount of the credit, the type of the credit that qualifies, the facility where it's made, the pre-registration number, address, that kind of information. And then both the seller and the buyer will attach that to their tax return when they file their returns, and that sort of completes the transfer process. For direct pay, there's obviously no transfer, so the amount is sort of claimed directly from the IRS at the time that the return is filed. And so, kinds of thinking, if you're on the manufacturing side and you're thinking about, okay, direct pay versus transferability, if you're transferring credits, you can negotiate with the buyer sort of when you receive payment for the credits. And as I said before, what we've seen in a number of transactions is that there might be periodic payments over like quarterly periods or something like that, where, at every quarter end, there's a report that's provided by the seller to the buyer, and then there's a payment that's made. Whereas on the direct pay, you're making the claim for direct payment at the end of the year when you file your return. So it's a slightly different timing profile as well.
I would just say, like, that point that Ethan made at the end, that the quarterly payment through transferability has been kind of a game changer for a lot of manufacturers who need that kind of cash flow coming in and don't want to wait until the end of the year, right? Direct pay, I think, our coalition did advocate for kind of quarterly payments for direct pay. The IRS determined that that's not feasible right now. So because the direct pay is an annual process, whereas you could get a little creative on the transferability side, that has been one way or one method that's made transferability more attractive to a lot of members. So even if they're selling the credit for a couple cents less than, dollar for dollar, they're still getting the cash flow that they need to make further investments, expand their facilities, establish new manufacturing lines to meet the demand for solar and other technologies here in the US.
Yeah, super helpful, guys. Well, so in the interest of time, let's pivot a little bit, talk about the domestic content bonus. We have a lot of folks who have participated or joining the webinar, I think, to hear about that. So let's go ahead and talk about, how we are seeing the DC bonus sort of play out from the point of view of, its interpretation, how folks are claiming it. And I think that, Justin, that was one of the things that brought us to you, is to learn about how you at KPMG are helping customers claim and adjudicate the domestic content bonus. So I'd love to hear your just, 2 to 3 minute overview of sort of how that process works, and how the DC bonus is being kind of claimed in practice. And I'll just, as a table setting point, I think I'll acknowledge something that we all sort of know, which is that the DC bonus has changed a bit and it's somewhat complicated to take advantage of. And so, we have been looking for the industry to standardize. Obviously, the work that you all do at KPMG, I think, is an important part of that. So love to hear, kind of where you see the process of qualification claiming for the DC bonus going.
Yeah, so we've definitely seen it kind of morph over time, and some updates with the safe harbor guidance has helped with certain types of projects, but on projects where there's not necessarily a safe harbor approach that taxpayers can elect, for it to be successful, we find it needs to be a partnership between all parties, starting with the contractor, obviously starting with the taxpayer, but then starting with the contractor developer who's helping plan or plan out the site. And then followed by a partnership with all manufacturers. It really does require input from all parties. And we have seen, over the course of time, everybody become more involved and willing to participate in order to help pass on the benefit of this credit. For contractors, we are seeing them do in supporting them with upfront planning of the project. So identifying where in the project is certain iron or steel so that they can keep visibility to what sort of iron or steel must be produced in the United States, because that is an all or nothing requirement. But then we're also seeing them do scenario planning of what manufactured products should come from the United States in order to meet the specified percentage requirement. But it does, it comes with some work and training. Some are more experienced than others. But I think with manufacturers and even developers, it does help to have a intermediary as a third party, because a lot of at least for domestic content, there is some sensitive information that needs to be collected. And it is helpful to have a third party there so that a third party can help collect it under confidentiality. That way, any sort of sensitive direct cost or supply chain information can remain confidential from ultimate buyers. And we've seen that helps manufacturers or developers really come to the table and support clients and trying to approve and claim this credit.
Well, let's kind of disaggregate the conversation a little bit. There are basically these two pathways for claiming the DC bonus, right? You can either demonstrate that you meet the applicable percentage levels for your products that you've purchased and for your steel and iron, structural steel and iron, all of which has to be produced in the US, or there are these safe harbor options available. And so, Yogan, I think we were talking about that on the pre-call. I know we are all to some degree kind of familiar with that, but I thought I might kick it to you to talk a little bit about, especially from the policy perspective, what is the nature of the safe harbor that the IRS has produced for the DC, claiming the DC bonus, and I'd love to hear if you have any color on how members are, navigating that. Is it a genuine benefit? Are they still kind of going the cost-based methodology? But yeah, I'd love to shuffle it over to you maybe to provide some color.
Yeah, I mean, look, I think the safe harbor that came out in January of this year was very important to a lot of our members. I think it provided it's a lot easier to use those tables because they give you very specific percentages for those specified projects. And it is just kind of adding all that up, right? I mean, I'm simplifying it a little bit, but that is effectively what KPMG and Davis and Polk can help a lot of the developers do. And so from our members' perspective, right, like they have the confidence and their customers have the confidence that they can all align around kind of what those percentages are without sharing at least some of the sensitive data that Justin was referring to. I think with the initial guidance in 2023, a lot of our members would have had to share a lot of sensitive cost data. And some manufacturers are comfortable doing that, some manufacturers are not. But in the end, it gets a little tricky. And so from our perspective, having those kind of percentages out there where everybody knows what the rules are, what the percentages are, it's generally based on sound NREL data. That was very critical. I think the other thing that was important for our members was seeing that pathway to wafer. So manufacturers who had solar, domestically produced cells with domestically produced wafers, getting that extra boost, that just incentivizes that part of the supply chain that is so critical to onshoring the entire solar industry. And so those were really important for us. I think, as we sit here today, I think one thing that I know our members would like to see is the percentages, the percentage for 48 CAPI increase and rise over time. It does for 45Y from 40 to 55%. But for 48E, it's kind of stuck at 40% in the statute. And so, I know some folks are financing projects assuming that will be fixed at some point or whatnot, or tweaked in some way. I think, having that, tweaked in statute is very critical for us to, again, continue to drive investment beyond just the module and the cells, but really get at the wafers and everything else that we need to have a fully domestic solar supply chain.
Yeah, and we do want to get into and be remiss not to talk about those percentages and that ostensibly a bit of a drafting error, perhaps, that, sort of created this bifurcated treatment for PTC and ITC. But I also wanted to pose quickly one of the questions that came into the chat to Justin, who I think, to the best of your knowledge, if you could try to answer this question. The question is essentially when the tariffs are being applied or assessed against imported products or components, how or do those influence the costs that are being used to establish the domestic content percentages? So if a DC block is manufactured in the US using battery cells imported from China, should the tariff and logistic costs associated with the cells import into the US be factored into the price for the purpose of establishing, I think, DC eligibility or the domestic content cost? So I hope I didn't butcher that, but yeah, Justin, any thoughts you have on that subject?
I'll answer the the best I can is that a lot of the tariffs we've seen recently in the news are very industry focused. So there are tariffs on steel and aluminum, tariffs on automotive parts, with some other tariffs in discussion for copper, lumber, etc. So a lot of, but prior to that, we did see several tariffs really focused on the energy sector. So lots of tariffs on solar cells or other sort of green energy type products like batteries. As far as utilizing those and calculation of a safe harbor method, I think our administration did a well job of working with industry to establish those percentages. And then as far as, if a direct cost approach is being utilized, we would refer back to the definitions of direct cost within the regulations, which is the manufacturer's direct cost to produce that item. So if that manufacturer's direct cost is prior to importation, we would go back to them and solicit them for that direct cost, which would ultimately be pre-tariffs.
Okay. Interesting. Well, let's talk about, I think, the kind of what seems like the elephant in the room with the DC bonus, which is the percentages that are applying to obviously 48E, the new tech neutral ITC, and then 45Y, the tech neutral PTC. And Ethan or Yogan, kind of defer to either of you in terms of, if you want to provide a little context around, so there are these percentages of manufactured products and components that you have to obtain from a domestic supply source. And then there's, these different methodologies for establishing how you weight those products. But so what's the deal?
I'm happy to provide an overview, and then Yogan, I think you can provide some color. The way that the sort of code is set up, because I think this all kind of has to do with cross references. We have the Section 45 production tax credit and the Section 48 investment tax credit that applied, up to the beginning of 2025. And so those credits, they still apply now for projects that began construction before January 1st of 2025. But, effectively going forward, we are under the 45 cap Y and 48E clean tech neutral clean electricity credit regime. And so, rather than 45Y and 48 cap E, rather than applying to specific technologies, they apply to technologies that effectively produce zero greenhouse gas emissions. And the domestic content percentage in Section 45, old Section 45, is 40%. And there's no step ups over time, largely because that statutory provision goes out of, it just stops after 2025. Section 45Y, which is the sort of continuing production tax credit now, has a step up provision that basically says for projects that begin construction before 2025, the domestic content percentage has to be 40%. And then it goes to 45% for projects that begin construction this year, and then so on, up until 55% for projects that begin construction in 2027 or later. And so ultimately, you're going to get from 40 to 55% by 2027. The investment tax credit has kind of a similar dynamic where this old Section 48 credit has, is basically now only for projects that are grandfathered into that regime, and new sort of investment tax credits are claimed under Section 48E. If you look at the domestic content bonus for Section 48E, it, rather than write out the requirements, it has a cross-reference to the old Section 48, which then has a cross-reference to old Section 45, which is just stuck at 40%. And so I think people view that as perhaps a drafting error, because why should the production tax credit step up to 55% where the investment tax credit is at 40%? But, I think that is what the statute says. If you read the domestic content notices that the IRS has put out, they've stated the rule that way. So, that is kind of the law, but I think people view either that it might be clarified in future legislation or corrected, because it when you read kind of through it, it does seem like perhaps it was a technical glitch. I don't know, Yogan, if you had a view on that, but
yeah, no, I think I don't think I could have stated it better myself, Ethan. I think, that I think the intent was to probably, increase those percentages. I think it, it didn't, for whether it's a technical glitch or a drafting or whatever we want to call it. It happened. It is what it is. And I think for me, where I sit and kind of looking forward is, our hope as my coalition and my members want to see that percentage go up, at the very least from 40 to 55%. There's that the House Republicans had an opportunity to do that in their version of OB3. They did not. We'll see if Senate Republicans and the Senate Finance Committee are able to address that or not. I think I thought it was notable that the House Republicans chose not to address that in their text. And so, I mean, if this is kind of the vehicle, this OB3 is the vehicle right now. And so if it doesn't get addressed now, I don't know when or if it will get addressed in any meaningful way in the near future. So that's kind of how we see it. And I think from our perspective, it's an opportunity for Senate Republicans to say that this is an important incentive and we care about domestic manufacturing, and this is a good way to drive investment in more manufacturing across the US. So that's kind of our perspective there.
Yeah, that was such a perfect exposition. So thank you to both of you for that. And I think what you've done very eloquently, Yogan, is you've transitioned us to a policy discussion. So I think we should take that opportunity. I also really like your abbreviation of the One Big Beautiful Bill Act of 3. That's the first time I've heard that, and not
I
just
haven't heard that either. I like that.
I don't think I can take credit. I think Secretary Bissett said it yesterday and when he was testifying. So I'm going to give him credit for that.
Great. Well, it's a lot faster than trying to say the whole name, for sure. Oh. Well, why don't we, cue you up, Yogan, to give us a little bit of the sort of where are we in terms of this process? You obviously described that the House has passed a bill, but kind of where do we go from here? And especially in the context of domestic manufacturers, what do we want to see, and I'll open the floor, of course, afterwards to everyone, but what do we want to see from the Senate and from the political process going forward?
Yeah, so as you noted, that the House passed their bill by Memorial Day weekend, and the Senate is kind of in the throes of it right now. I know the industry has come out strong and is out there every time I'm on the Hill. I see somebody in the industry up there as well with me, and hitting all 53 Republican offices. That is the game right now. Is to educate them, let them know the importance these incentives what they mean for jobs in their states, what they mean for the economy, the not just the direct jobs, but the indirect jobs that are being created, the cost savings that are being derived by consumers on electricity prices, and the ability to set us up to level the playing field versus China, right? I mean, that is a big driver for 45X. That was kind of the goal from the beginning. Those conversations are ongoing. I fully expect, I think, Senate Finance and Senate Majority Leader Thune are driving towards trying to get legislation and text out the door as soon as possible. Senator Crapo, chairman of the Finance Committee, briefed members yesterday, at a very high level on kind of, they're definitely going to be modifying what the House bill did to the tax credits, kind of across the board. We're hoping for slightly better outcomes on transferability, for example. But from our perspective, our kind of number one ask here is that the Senate needs to really extend 48 CAP-E much further than the House bill does. The 60-day commence construction is effectively an easy way to just kill the credit, kill the demand for domestic manufacturing. I think from our perspective, a lot of my members' customers would then just pick up the phone and go to their Southeast Asian suppliers or other foreign suppliers rather than buy domestic because the incentive is not there. And in the House bill, I think I would actually argue the OB3, the House version of OB3, is a big giveaway to Chinese manufacturing rather than domestic manufacturing the way it's designed right now. So our number one priority is to extend the duration of Section 48 CAP-E, ideally, to commence, start construction before December 31st, 2029. I think that aligns a little bit more with the duration of 45X. So you have that kind of aligned, ideal policy alignment. Political reality, I don't know if we're going to get there, but I think you miss 100% of the shots you don't take, I guess, right? So we're definitely going to ask for that. We think having smart administrable fiat restrictions are important. I think making sure that there's black letter law in the statute, because waiting for guidance, the domestic content guidance was a great example of what happens when you have to wait 2.5 years for helpful guidance. It just kind of kills the credit or freezes the investment. So having fiat restrictions that folks like Ethan and Justin can quickly interpret and help deals get through are going to be critical for even our membership. Fixing domestic content and making sure that step up exists. That's a priority for us as well. So, and then at the last minute, the House kind of killed this, leasing the third party ownership structure for 48 Cappy as well. That's important for our members, customers as well. And so we're making sure that folks understand, that's a big part of the market in the US. Those systems end up having higher American content in the products anyways, even if there is not a domestic content requirement or anything like that. But making sure that there's a pathway for the residential market to not just completely crash. I think that's what we're focused on.
Excellent, thank you. And Justin, I thought there's a question that I kind of skipped over on accident, but I want to resurface it now because I think it's germane to this discussion. And Yogan brought up the foreign entity of concern, machinations in OB3. So the question here is really, how do the tariffs on the subcomponents or the sort of the political treatment of the manufacture of a subcomponent apply to an imported product from a different country, but which may have a subcomponent manufactured in a place like China? So if you've got a small part that goes to an Indonesian factory, is incorporated into a product and then imported into the US, can you kind of comment on, I think the immediate question is the subcomponent treated, is there a tariff separate or a preferential or negative treatment of the component based upon its original sourcing in China? But then also, how can you comment on how that would affect the product in the US when it's ultimately put in service?
Yeah, that very, I would say, just complex question, but I'll say it's just the importance of understanding the supply chain and of the products and subcomponents that you are procuring. Just Katie, for the example of a subcomponent in China that goes to Indonesia for further processing, that alone is one analysis to determine what is the origin, because has the Chinese component been substantially transformed through the processing in Indonesia? And if that answer is yes, then it is not just one product of Indonesia, carries a completely different tariff. So each scenario, each question does require like an analysis, and yeah, that's a very complex answer, but it all does come down to this term, substantial transformation, and value of partnering with a trade compliance professional in your organization.
Well, and I'll let Ethan close us out in the interest of time. We have about 2 minutes left, but Ethan, the question to you is basically, what are you paying the closest attention to from the policy perspective? And is there anything that you'll be particularly focused on when we do get text from the Senate as early as tomorrow, as Yogan said?
Yeah, I mean, the question, there's a lot. I think in the context of 45X, there's really two things that I think jump out at me as things to really keep an eye on. One is sort of what they do with transferability. The House bill basically would give us transferability would be repealed beginning in 2028, and the credit runs through 2030 or 2031, depending on kind of when the phase out happens. And so I think thinking about what happens with transferability is one thing. The other are the foreign entity of concern or prohibited foreign entity rules. I mean, as drafted in the House bill, it's not clear exactly where you divide the line between sort of components that cannot be sourced from China and components that and then parts that could be, and seems very broad, and I think that clarification on how those rules will work, assuming that the concept sort of stays in the bill, is going to be critical for people to understand. And I think as was already pointed out, if it just defers to Treasury and the IRS to kind of put guidance together, that then create some period of uncertainty depending on how quickly we can get guidance. And so having sort of clear rules in the legislation would obviously be helpful to practitioners.
Great. Well, thank you all so much. I will start our sign-off process. I wanted to just flag to the folks on the line, first of all, a huge thank you to our panelists for covering such complex material and doing so so clearly and eloquently. So thank you, Justin, Ethan, Yogan, for that. And I also wanted to just touch on something that Yogan also mentioned, which is that we are dealing with a lot of policy uncertainty. We have this sort of short period of time wherein companies are trying to, establish as much certainty as they can in their supply chains. And Crux, through our debt marketplace, we're acting as a bit of a facilitator for folks to procure equipment for the purpose of safe harboring assets. So if there's anyone on the line who's looking for a solution like that, effectively equipment financing or a manufacturer with available capacity that's not yet bought out for 2025, please reach out to us at partnerships@cruxclimate.com. Love to help you with that. Of course, the reality of the policy environment is that there's a lot of change happening. Hopefully, the scramble to safe harbor equipment ends tomorrow when the Senate produces legislation in line with what Yogan laid out. But if it doesn't, we're here to help. And so are the folks at KPMG and SEMA and Polk. So again, appreciation to everyone on the line for joining us today. And I hope everyone has a wonderful Thursday.